Whether you are prepping your portfolio for what looks to be a incredibly rocky week, or you're just, simply trying to make sense of this overwhelming barrage of headlines hitting the wire today, we have you covered. Welcome to the Steep Dive.
Thank you. It's definitely a critical day to be looking at the data.
It really is. And the mission for our time together today is incredibly clear, sharply focused on the realities facing every single investor on this specific day. Monday, March 9th, 2026.
Right.
We are looking at a market undergoing a massive real-time stress test. So we need to figure out what exactly is happening on the trading floor right now. How is the S&P 500 holding up under the weight of these simultaneous macroeconomic shocks?
And beyond just the tape, we need to uncover what the top institutional analysts are saying in their private client notes.
Exactly. What actionable steps should you be considering for your own capital? And importantly, mapping out the crucial economic landmines waiting on the calendar later this week.
The urgency of those questions really can't be overstated right now. We're processing a staggering volume of real-time data, but the objective here, for you listening, is to filter out the panic. We need to isolate the structural mechanics of what is actually breaking and, surprisingly, what is holding firm.
To achieve that, we are pulling from a really dense stack of sources today. We've got live market data from institutional trading desks, comprehensive economic outlooks from S&P Global and Zacks Research. We're looking at breaking financial news covering global commodity supply chains and a whole slew of internal strategy notes from the major banks. And I have to say, the picture emerging from this data is stark. We are right in the middle of a historic, highly volatile trading session.
Yeah, there is a palpable sense of a structural shift occurring in the global financial architecture today. If you look at the macro landscape, it essentially boils down to the sudden, violent collision of two distinct forces.
Let's unpack that. What's the first force?
First, we have an escalating geopolitical shock that has struck the absolute heart of the global energy infrastructure.
Right.
And second, that external supply shock has collided with an internal, systemic liquidity constraint, one that has been quietly building within the shadow banking sector for the past roughly 18 months.
So we're seeing these two forces intertwine, sending shockwaves through equities, government bonds, commodities, digital assets, everything.
Exactly.
Okay, let's unpack this with the immediate damage report. The numbers flashing across screens right this second. The global markets are bleeding. The S&P 500 is currently taking a drawdown of roughly 1.2% to 1.5% across the sessions.
Yeah, it's fluctuating heavily in that 6,640 to 6,655 range.
The Dow Jones Industrial Average has shed hundreds of points, trading erratically in the 46,700 to 47,500 range. And the Nasdaq, which has essentially been the engine of global equity growth for the last 3 years, is down over 1.2%.
It's a coordinated retreat across all the major U.S. indices. But it's not domestically isolated. The contagion is global.
Right, I was looking at the Asian markets.
Yeah, the Nikkei 225 in Japan plummeted significantly, hitting lows of nearly 7% down before recovering slightly. The Hang Seng dropped over 3%. And the European markets, specifically the German DAX and the French CAC 40, are taking severe hits.
And the catalyst driving this synchronized liquidation is the escalating military conflict in the Middle East involving the United States, Israel, and Iran.
It is.
Now, I want to pause here and make our parameters for this deep dive explicitly clear for you listening. We are entirely bypassing the political commentary, the geopolitical dynamics, the diplomacy, the ethics of the conflict. None of that is our purview today.
No, we're looking at this strictly through the lens of economic impact, supply chain disruption, and market mechanics.
Exactly. And right now, the entirety of that economic impact is being funneled through one of the most critical maritime choke points on Earth.
The Strait of Hormuz.
Yeah.
Roughly 20% of the world's total global oil consumption passes through that specific, very narrow waterway. It is essentially the central routing hub for global energy. And right now, it's facing unprecedented shipping disruptions.
And the commodity markets aren't just reacting, they are repricing reality. West Texas Intermediate WTI crude surged over 10% today,
It blasted right past that psychological barrier of $100 a barrel.
trading around $100.83 right now. Brent crude, the international benchmark, saw an even more massive spike. It's trading in a wildly volatile range between $102 and $114 a barrel.
And it's not just crude oil either.
No, I'm looking at the Dutch TTF futures. That's the pricing benchmark for European natural gas. They surged by up to 30% in a single session.
A 30% intraday move on a foundational energy commodity. I mean, that is the kind of standard deviation event that blows up risk models on trading desks.
Completely. And you can see that fear bleeding directly into the volatility indices. The VIX, Wall Street's so-called fear index, spiked above 31 today. That is the highest level we have seen since April 2025.
Right. And for context, a VIX above 30 indicates that institutional market participants are aggressively buying put options. They're willing to pay massive premiums for portfolio insurance because they anticipate violent outsized swings in the S&P 500 over the next 30 days.
But the underlying mechanics of this oil spike require a deeper look, because this isn't just a speculative panic, is it?
No, not at all. It is a forced physical supply chain failure. We are seeing major Gulf producers, Saudi Arabia, Kuwait, Bahrain, and the UAE actively cutting their oil output.
Now, I want to challenge that because on the surface, that makes zero economic sense.
How so?
Well, if you were an oil-producing nation and the price of your primary export just spiked over $100 a barrel, your immediate incentive is to pump as much volume as physically possible to capture that premium. Why would they cut production during a price supercycle?
Because they're running into the hard limits of physical infrastructure. They simply cannot ship the oil out.
Because of the Strait.
Exactly. With the Strait of Hormuz compromised, the maritime insurance premiums for oil tankers have skyrocketed to prohibitive levels. And that's assuming tanker captains are even willing to make the transit through a conflict zone.
Right.
Therefore, the crude these nations are pumping has nowhere to go but into domestic onshore storage facilities. The problem is, those storage tanks are rapidly hitting maximum capacity.
Tank tops.
Yes, once you reach tank tops, when there is physically no more room to store a single barrel of crude, you have no choice but to shut in the wells and halt production at the source.
Think of it like a massive financial clearinghouse suddenly going offline. If the central servers that process all the transactions are down, it doesn't matter how much capital the individual banks have to trade.
The flow stops entirely.
Exactly. The flow stops and the liquidity backs up into the origin accounts. Here, the Strait of Hormuz is the clearinghouse, and the oil is backing up into the desert until the system fundamentally halts.
That is a massive macroeconomic shock. And historically, when a shock of this magnitude hits, capital flies toward safe havens.
Which we are seeing with the dollar. The U.S. dollar index, the DXY, is pushing up above 99.1. Capital is seeking the ultimate liquidity and safety of the greenback.
But the behavior of other traditional safe havens today is deeply concerning.
You are referring to the divergence in gold and Bitcoin.
Exactly that. Usually, when geopolitical tensions explode, gold catches a massive bid. Investors flock to it.
But today, gold is actually trading lower. It's dropping into the $5,070 to $5,100 range.
And Bitcoin, which has been heavily marketed for years as a non-sovereign hedge against systemic macro chaos, has completely slumped. It dropped below $68,000 to trade near $66,000.
So if the market is terrified, why is capital fleeing the very assets designed to protect against terror?
The breakdown in those correlations points directly to internal stress within the plumbing of the financial system. When gold and Bitcoin drop simultaneously with equities during a macro shock, it indicates a severe dash for cash.
Meaning they aren't selling because they hate the asset.
Right. Investors aren't liquidating gold because they've lost faith in its store of value. They are selling it because it's highly liquid, and they are facing acute capital calls elsewhere.
Margin calls.
Precisely, margin calls. If an institutional fund is heavily levered long on equities or caught on the wrong side of an energy derivative trade, their prime broker will demand immediate additional collateral as those positions bleed.
And when you get a margin call, you don't sell your illiquid asset.
No, you sell whatever you can convert to US dollars the absolute fastest. Gold is highly liquid. Bitcoin is highly liquid.
So the selling pressure we are seeing in those assets today is just a mechanical symptom of deleveraging.
Yes, market participants are indiscriminately liquidating to reduce gross exposure and raise cash.
That structural stress, that desperate need for liquidity, brings us to what might be the most consequential part of the data we are reviewing today.
The private markets.
Yeah. While the public equities and commodities are capturing the mainstream headlines, our sources are highlighting a quiet, potentially devastating crisis brewing in the private markets.
It's the canary in the coal mine.
Exactly what former PIMCO CEO Mohamed El-Erian posted on X today. He asked if we are witnessing a canary in the coal mine moment, and he explicitly compared today's private market mechanics to August 2007.
That is a heavy comparison.
Very. What's the specific catalyst for El-Erian's warning?
It's a major development out of Blue Owl Capital. Blue Owl has permanently halted Regular quarterly redemptions from OBDC2, which is one of their retail-focused private credit funds.
And this didn't just happen out of nowhere, right?
No, this decision didn't happen in a vacuum at all. It immediately followed a $1.4 billion asset fire sale, where Blue Owl sold off a massive block of the fund's portfolio to pension and insurance investors at 99.7% of par value.
Wow. And they aren't the only ones. BlackRock has also limited withdrawals on a $26 billion private credit fund due to an overwhelming surge in redemption requests.
Yeah.
I want to make sure we define the scope of this for you. We are talking about the $1.8 trillion private credit market.
It's massive.
For listeners who might be heavily allocated in public equities or standard index funds, they might not realize how big the private credit space has become. How did this market get so large, and why is this specific liquidity mismatch causing multi-billion-dollar funds to suddenly lock their gates on everyday investors?
To really understand the vulnerability here, we have to look back at post-2008 financial regulation. After the Great Financial Crisis, regulations like Dodd-Frank essentially forced traditional banks to step back from lending to middle-market companies due to stricter capital requirements.
Right. The banks couldn't take the risk anymore.
Exactly. So alternative asset managers, private equity firms like Apollo, Blackstone, KKR, and Blue Owl stepped into that void. They raised hundreds of billions of dollars to originate direct bilateral loans to these companies.
But these are private loans.
Yes, they do not trade on a public exchange. They lack a secondary market. They are fundamentally illiquid.
So if an asset manager makes a $100 million loan to a regional logistics company, they can't just open a brokerage app and sell that loan if they suddenly need cash.
No. They are locked into that paper for the duration of the term, which is often 5 to 7 years.
Okay, so that is the core of the issue. Historically, these asset managers only raise capital from institutional investors, right? Sovereign wealth funds, massive state pensions, university endowments.
Entities that have decades-long time horizons. They can afford to lock their capital away in illiquid funds for 10 years.
However, as the institutional market became saturated over the last few years, these asset managers pivoted aggressively to the retail market.
They wanted the capital of the everyday accredited investor.
So to get it, they created structures like business development companies or BDCs, and they marketed these semi-liquid funds.
Yes, so semi-liquid is the marketing term.
They promised retail investors the high yields of private credit, but added a crucial caveat. They promised investors they could redeem their shares and get their cash back at the end of every quarter.
But hold on. How can you mathematically promise retail investors quarterly liquidity when the underlying assets you are purchasing with their money are 5-year illiquid corporate loans?
It sounds like an inherent structural contradiction.
It is a profound structural contradiction, and it relies entirely on the assumption of normal market conditions. The fund managers assume that in any given quarter, only a tiny fraction of investors will actually ask for their money back.
Right.
So they keep a small buffer of cash on hand to satisfy those redemptions, while 95% of the capital remains locked in illiquid loans.
But when a macroeconomic shock occurs, like a war in the Middle East, and $100 oil retail investors get spooked,
They rush for the exits simultaneously. The fund manager looks at the redemption queue, looks at their tiny cash buffer, realizes they cannot possibly pay everyone, and has no ability to quickly sell the underlying loans.
so their only defense mechanism is to drop the gates and halt redemptions entirely.
Exactly. Which brings us directly back to Elitarian's comparison to August 2007.
Yeah, I was looking back at the timeline of the Great Financial Crisis. The actual market crash and the collapse of Lehman Brothers didn't happen until the fall of 2008. But the fuse was lit in August 2007 when two Bear Stearns hedge funds, the high-grade structured credit strategies, enhanced leverage funds, froze redemptions.
Right.
Why is Elitarian drawing a parallel between those specific mortgage funds and today's private credit BDCs?
Because the underlying mechanism of failure is identical. The Bear Stearns funds held complex, highly illiquid subprime mortgage derivatives. They relied on short-term financing and promised investors liquidity.
And when the housing market began to show early signs of stress, investors demanded their money back.
Yes, Bear Stearns tried to sell those illiquid mortgage assets to raise cash, but found that the secondary market had completely evaporated. There were no bids.
You had to freeze the funds, trapping investor capital.
It was the first undeniable proof that the underlying collateral of the financial system was impaired. Elitarian is pointing out that today, private credit funds are promising short-term liquidity against illiquid corporate loans.
So if panic sets in, the inability to sell those loans could perfectly mirror the inability to sell those subprime CDOs in 2007.
It's the exact same liquidity mismatch.
But Blue Owl is actively defending their position. They are pointing to that $1.4 billion fire sale and saying, look, we sold these assets at 99.7% of par value.
Yes, they are.
They are using that execution to argue that their portfolio is rock solid and the underlying loans are still worth exactly what they claim on their balance sheet. Is that a valid defense, or is the market treating that 99.7% figure with skepticism?
The market is incredibly skeptical, which is why shares of alternative asset managers like Apollo, KKR, and Ares all took heavy hits today alongside Blue Owl.
Selling one block of assets to a friendly syndicate of pension funds at 99.7% of par might stave off immediate insolvency, but it doesn't solve the broader valuation question.
No, because in private credit, assets are marked to model, meaning the fund manager essentially dictates what the loan is worth based on their own internal math, rather than mark to market, where an open exchange dictates the price. The overriding fear here is contagion.
Well, if BlackRock and Blue Owl are both facing surges in redemption requests, it stands to reason that dozens of other mid-tier private credit funds are facing the exact same tidal wave.
Withdrawal requests in large BDCs already spiked 200% in the fourth quarter of 2025. And that was well before this Middle East shock even materialized.
Exactly. And if dozens of funds are forced to liquidate assets simultaneously to meet margin calls or investor redemptions, who's left to buy them?
If a massive supply of private loans hits the market, and there are no institutional buyers willing to step up, the clearing price will not be 99.7% of par. It might be 80% or 60%.
And if those assets have to be remarked at those distressed levels, it wipes out the equity in these funds, triggers debt covenants, and causes a cascading panic that bleeds directly into the traditional banking sector that provides leverage to these private funds.
It's a domino effect.
So, with the private markets locking their doors, the geopolitical supply chains fractured, and public equities taking a beating, you would naturally assume that Wall Street analysts would be issuing universal apocalyptic warnings.
You would think so.
But as we comb through the research notes published today by the major institutions, that is not the case at all. The analytical community is violently divided. We are essentially looking at three distinct camps right now.
The optimists, the pessimists, and the fundamentalists.
It is one of the most remarkable divergences in institutional outlook we have seen in years. So, with oil skyrocketing and private funds locking the gates, what are the smartest minds on Wall Street actually saying about all this?
Let's examine the optimists first. They are heavily leaning on historical precedent and the structural changes in modern market mechanics. Analysts at JP Morgan published a note today explicitly advising clients to treat this as a buy-the-dip scenario. Yes, they presented data showing that the typical reaction to a major, isolated geopolitical shock is a 5% to 6% drawdown in the S&P 500, which has historically clawed back within a matter of weeks.
And JP Morgan isn't on an island here. Deutsche Bank Research circulated a quantitative study of geopolitical events over the last 50 years.
What did they find?
They found an average initial drop of 6% to 8%, but noted that the market typically recovers those exact losses in roughly 3 weeks. Raymond James added to this, showing that historically, regardless of the severity of the initial headline panic, the S&P 500 is higher 1, 3, 6, and 12 months after these types of events.
And UBS concurred, stating that geopolitical shocks rarely cause structural permanent damage to corporate earnings.
So the optimist camp is basically telling you, shut off the news, ignore the panic, and buy the discounted equity.
But then you have the pessimist camp, who are arguing that looking at historical averages is blinding investors to the unique macroeconomic trap we are currently in.
Veteran market strategist Ed Yardeni is the prime example here.
He just released a note slashing his probability of a market melt-up, a sustained, exuberant rally from 20% down to a mere 5%.
He characterized the Federal Reserve as being stuck between, and I quote, Iran and a hard place.
That's a great soundbite. But the economic reality he is pointing to is stagflation, which is arguably the most destructive environment for a balanced portfolio.
Stagflation is the nightmare scenario. Because if this Strait of Hormuz blockage persists and oil anchors itself well above $100 a barrel, that energy cost bleeds into every single physical good in the economy.
It drives up headline inflation almost immediately.
Simultaneously, that $100 oil acts as a massive regressive tax on consumers and corporations. It destroys discretionary spending and crushes profit margins.
Which slows economic growth and drives up unemployment.
So the Fed is completely paralyzed. If they attempt to stimulate the slowing economy by cutting interest rates, they risk supercharging the oil-driven inflation.
But if they hike rates to crush the inflation, they guarantee a deep recession and spike the unemployment rate. They have no viable policy lever.
That is Yardeni's core thesis. However, there is a third camp, the fundamentalists.
Right. The fundamentalists are largely ignoring the geopolitical noise and the Fed's policy dilemma. They are instead laser-focused on bottom-up corporate data.
Zacks Research published a report today focusing on upcoming Q1 2026 earnings expectations. And despite the macro chaos, their data indicates that corporate profitability expectations remain stunningly robust.
I was looking at the Zacks data, and the numbers are almost hard to believe given the backdrop. Total S&P 500 earnings for Q1 2026 are expected to jump 11.3% year over year.
That is double-digit earnings growth in the middle of a global supply chain crisis.
But the caveat is crucial. That growth is not distributed evenly. It is being heavily, almost entirely propped up by the technology sector.
Tech earnings alone are projected to grow by an astounding 23.7%.
And if you strip the tech sector out of the S&P 500, the remaining 400-plus companies are only expected to grow earnings by a meager 5%.
S&P Global Ratings corroborated this dynamic in their own macro outlook today. They pointed to what they call AI tailwinds.
Their argument is that the sheer volume of capital expenditure, the hundreds of billions of dollars being deployed by mega-cap tech companies into artificial intelligence infrastructure, data centers, and advanced compute, is acting as a massive, independent macroeconomic engine.
Is providing enough forward momentum to offset the drag of high interest rates and geopolitical friction.
We have to evaluate this through the lens of economic history, though. The pessimists are heavily relying on the 1970s playbook.
Back in 1973 and 1979, when we had the massive Arab oil embargoes.
Exactly. The global economy back then was intensely manufacturing-based. If the price of crude oil quadrupled, it decimated the broader economy because producing almost any unit of GDP required immense amounts of physical energy.
But today, the U.S. economy has transitioned heavily into a digital, knowledge-based architecture.
So if oil goes to $120 a barrel, does that fundamentally damage the profit margins of a SaaS company, a cybersecurity firm, or a cloud computing giant in the same way it damaged a steel mill in 1974?
That is the multi-trillion-dollar question. The metric you are referring to is the energy intensity of GDP, the amount of energy required to produce $1 of economic output.
And over the last 50 years, that energy intensity has plummeted. The U.S. economy is vastly more energy efficient today.
Therefore, while $100 oil is acutely painful for logistics companies, airlines, and everyday consumers at the gas pump, it may not be the universal kill shot to corporate earnings that it was half a century ago.
The tech sector might actually have the margin resilience to carry the broader index through the storm.
What's fascinating here is how the mechanics of modern market structure heavily favor the optimists by the dip thesis.
Algorithmic trading, quantitative easing conditioning, and the dominance of passive ETF flows have essentially hard-coded a reflexive buying mechanism into the market during drawdowns.
But the danger of hard-coded resilience is that it breeds systemic complacency. If algorithms and retail investors are trained that every 5% dip is an immediate buying opportunity, the market loses its ability to accurately price tail risk.
Everyone assumes the central banks or the tech megacaps will save the day until the exact moment they can't.
So what does this all mean for you, the investor?
That's the practical application of all this conflicting data. For the investor listening to this, observing the private credit gates slamming shut, tracking the VIX spiking over 30, and reading deeply divided analyst reports, the real question is how to tactically maneuver.
We need to translate this mountain of analysis into actionable strategy. Let's break this down into defensive positioning, offensive opportunities, and the power of individual stock anomalies.
Starting with defense.
When macroeconomic risks multiply and correlations between asset classes start breaking down like we are seeing with gold and Bitcoin today, capital preservation becomes the absolute priority. One of our institutional sources detailed a strategic framework known as the cockroach portfolio.
The nomenclature is very deliberate. A cockroach is designed to survive extreme, catastrophic environments that eradicate more specialized organisms. A cockroach portfolio is engineered to survive anything: hyperinflation, deep recession, stagflation, or a geopolitical supply shock.
It fundamentally rejects the traditional 60-40 equity and bond split, doesn't it?
Completely. Because the 60-40 historically gets decimated during stagflationary periods because both stocks and bonds sell off simultaneously.
So what are the actual mechanics of a cockroach strategy? It involves highly specific, non-correlated assets. The research notes highlighted the use of 5 specific ETF structures.
They emphasize the inclusion of trend-following strategies, or CTAs.
These are algorithmic funds that don't care about fundamentals. They just mathematically follow price momentum.
Right. If oil is trending up, they buy oil futures. If bonds are trending down, they short bonds. It provides massive structural alpha during extended crises.
Another critical component of that defensive posture is what the analysts term moat-heavy equity ETFs.
In a period where $100 oil is driving up input costs across the supply chain, corporate profit margins are under severe threat. The only defense is pricing power.
Wide moat companies possess such a dominant competitive advantage, brand loyalty, or infrastructural monopoly that they can raise their prices to offset inflation without losing market share.
If you look back at the 1970s stagflation, companies with impenetrable pricing power were the only equities that managed to protect real inflation-adjusted capital.
Okay, so that covers the bunker strategy. But volatility always creates mispricing, and mispricing creates alpha for those willing to play offense. Where are the institutional desks looking for opportunistic entry points today?
Surprisingly, pockets of the high-yield credit market are flashing as opportunities in some of the strategy notes.
Why high yield?
As the broader market liquidates, the prices of high-yield corporate bonds and robust dividend-paying equities are driven down mechanically, which inversely pushes their effective yield higher.
So for an investor with dry powder on the sidelines and a calculated tolerance for duration risk, this violent market reset is creating entry points to lock in elevated long-term yields that simply did not exist a month ago.
Exactly. But the most fascinating strategic takeaway today revolves around anomalies.
It is the concept that a truly exceptional individual corporate narrative can completely sever a stock from the macroeconomic gravity of the broader indices. We have a textbook illustrative example of this playing out on the tape today with Hims & Hers Health, ticker symbol HIMS.
Remember, today is an aggressively risk-off session. The S&P 500 is bleeding, the VIX is spiking, and panic is the dominant emotion.
Yet, amidst all of that, HIMS stock soared over 43% today, trading around $22.50.
A 43% upside deviation on a day when the broader market is down 1.5% requires an incredibly potent fundamental catalyst.
And that catalyst has absolutely nothing to do with Iran, the Strait of Hormuz, or the Federal Reserve. Hims & Hers soared because they successfully resolved a massive legal feud with Novo Nordisk.
For context, Novo Nordisk manufactures Wegovy and Ozempic, the GLP-1 weight loss and diabetes medications that have completely revolutionized the pharmaceutical industry.
Because Novo Nordisk has faced chronic global manufacturing shortages for these drugs, the FDA placed them on a shortage list.
Which created a regulatory loophole.
Yes, allowing compounding pharmacies, like the ones partnered with Hims & Hers, to produce and sell compounded versions of the active ingredient, semaglutide, directly to consumers at a fraction of the cost.
Novo Nordisk obviously moved to protect their intellectual property and sued to shut down these compounding operations.
But the fact that Hims & Hers has resolved this legal overhang means they retain unimpeded access to a massive revenue pathway.
The total addressable market, or TAM, for GLP-1 weight loss drugs is staggering, with some analysts projecting it to reach $100 billion by the end of the decade.
By clearing the legal hurdle, Hims is positioned to capture a highly lucrative segment of that TAM by offering a cheaper, accessible alternative during a period of sustained brand name shortages.
This proves a vital point for you listening. You do not always have to trade the macro environment.
Exactly. If you find a company with a game-changing product, an expanding TAM, or a transformative legal resolution, its fundamental corporate gravity can completely override the geopolitical gloom.
That is a masterclass in idiosyncratic stock selection. However, I want to pivot back to the risk management side and urge listeners to critically audit their own portfolios based on what we uncovered earlier regarding private credit.
Right, the Blue Owl situation.
The situation with Blue Owl's OBDC2 is a glaring, unavoidable warning sign regarding liquidity. If you hold alternative assets, BDCs, private real estate investment trusts, or any fund structure outside of vanilla public equities and bonds, you need to read the prospectus today.
It doesn't matter if your private credit fund is advertising a 9% yield. If the fund is structured with gates and the manager slams those gates shut the moment the macro environment gets turbulent, that 9% yield is trapped in a vault.
You cannot eat paper returns. You have to audit your portfolio for true liquidity before a margin call forces you to sell your most pristine assets simply because your alternative assets are frozen.
Do not get lulled into complacency by the term semi-liquid. In a systemic crisis, semi-liquid immediately becomes entirely illiquid.
Assess the true duration of the underlying assets your fund holds, and ask yourself if those assets can actually be sold into a distressed market to meet your redemption request.
Preparation is everything. You audit the structural integrity of your portfolio before the hurricane makes landfall, not while the roof is tearing off. And speaking of incoming weather, what can be expected this week?
We need to map out the exact economic data dropping over the next few days.
The calendar this week is an absolute minefield, and the data prints will dictate whether this current market weakness morphs into a full structural breakdown.
The first variable we are tracking is geopolitical policy. Our sources indicate that the G7 is convening an emergency meeting to discuss a coordinated joint release of emergency oil reserves.
This is the direct sovereign policy response to the Strait of Hormuz blockage. We are talking about tapping the Strategic Petroleum Reserve, the SPR, but doing it in coordination with European and Asian allies to flood the global market with physical supply.
Correct. If the G7 announces a massive coordinated release, it could immediately crush the speculative premium currently priced into WTI and Brent crude.
It would serve as a temporary bridge to alleviate the inflation pressure while diplomatic or military solutions are pursued in the Middle East.
However, an SPR release is a finite tool. It doesn't solve the underlying transit issue, but it could drastically alter market sentiment this week.
So keep your alerts on for breaking G7 news. But beyond the geopolitics, the scheduled domestic economic calendar is the real crucible. I want you to grab a pen and physically circle March 11th and March 13th.
But before we get there, tomorrow, Tuesday, March 10th, we receive the U.S. ADP employment report.
That provides a crucial early read on private sector payrolls and the underlying health of the labor market.
The ADP data is a helpful preamble, but Wednesday, March 11th, is the main event. That morning, the Bureau of Labor Statistics releases the U.S. CPI, the Consumer Price Index.
This is the headline inflation metric that dictates broad market psychology. 2 days later, on Friday, March 13th, we get the U.S. Core PCE, the Personal Consumption Expenditures Price Index.
And the core PCE is the critical metric because it is the Federal Reserve's preferred gauge for inflation.
It strips out the highly volatile food and energy sectors to measure the baseline underlying inflation in the economy. We also get revised U.S. GDP estimates on that Friday.
Now, to play devil's advocate, why is Wall Street so hyper-fixated on these specific inflation prints this week when everyone knows they are backward-looking?
Right. These reports cover February. They aren't going to capture the massive oil spike happening today.
They are fixated on them precisely because they're backward-looking. The market needs to know what the baseline health of the economy was before this energy shock was introduced.
If the February CPI and PCE data come in hotter than expected, it proves that inflation was already sticky, entrenched, and reaccelerating before oil even crossed $100.
That would mean the Fed has absolutely zero runway.
Exactly. If base inflation was already a problem, the Federal Reserve's hands are completely tied. They will not be able to justify any protective interest rate cuts to help the equity markets weather the geopolitical storm.
Cutting rates into an environment of sticky base inflation plus an external oil shock would invite a catastrophic loss of credibility.
The market is going to hold its breath on Wednesday and Friday mornings because those numbers will dictate Fed policy for the rest of the year.
Circle March 11th and 13th for the macro data. But we also have crucial micro data hitting the tape.
The early Q1 corporate reporters are stepping into the spotlight. Oracle reports earnings tomorrow, March 10th, and Adobe reports later in the week.
The scrutiny on those two specific earnings reports will be intense. They're not just reporting on their own balance sheets. They're serving as the proxy, the ultimate litmus test for the entire AI tailwinds thesis we discussed earlier.
Both Oracle and Adobe are foundational layers in the enterprise software and cloud infrastructure transition toward artificial intelligence.
The market is desperately hoping that the tech sector's massive 23.7% projected earnings growth is real, and that it can physically carry the S&P 500 through this stagflationary fear.
If Oracle and Adobe deliver massive top-line beats, showcase expanding margins, and raise their forward guidance by citing insatiable enterprise demand for AI cloud services, it will validate the optimists.
It will prove the knowledge economy can transcend the physical constraints of $100 oil.
But if they show any hesitation in corporate IT spending, or if they guide down due to macro uncertainty, the foundational pillars supporting the S&P 500's valuation will crack.
It is a week where macro terrors and micro fundamentals are on a direct collision course.
We have covered an immense landscape of data today. Let's lock in the key takeaways. We are navigating a historic, highly volatile market session. An escalating kinetic conflict in the Middle East has compromised the Strait of Hormuz, triggering a massive energy asymmetry crisis that has pushed WTI crude past $100 a barrel and sent the VIX soaring above 31.
The public indices are bleeding, but beneath the surface, the $1.8 trillion private credit market is flashing severe warning signs.
Major asset managers like Blue Owl are halting retail redemptions, sparking legitimate fears of a 2007-style liquidity mismatch in illiquid corporate loans.
Furthermore, the analytical community is deeply fractured. While pessimists warned of Fed paralysis and 1970s-style stagflation, optimists lean heavily on historical recovery data and the belief that massive AI infrastructure spending will insulate the broader economy.
For your own portfolio, this is the time to audit your exposure. Understand your true liquidity parameters, investigate defensive strategies like mode-heavy ETFs that command pricing power, and look for idiosyncratic, macro-agnostic opportunities like HIMs and HERS.
And keep your eyes completely locked on the CPI print on Wednesday, the core PCE on Friday, and the AI demand signals coming from Oracle and Adobe.
As we wrap up, I know there is one final, somewhat counterintuitive paradigm you wanted to share from the strategy notes.
Yes. For years, the prevailing doomsday narrative in financial media has been the impending demise of the dollar. The idea that global friction and de-dollarization efforts by adversarial nations will inevitably destroy the U.S. dollar's status as the global reserve currency.
It's a very popular narrative. The BRICS nations trading in local currencies, the move away from the petrodollar.
But we must analyze the second-order effects of what is happening today. What if this massive escalation in geopolitical risk actually triggers the exact opposite outcome?
How would that work?
History shows us that escalating global warfare invariably sparks a massive, synchronized global defense spending boom. In a world defined by kinetic supply shocks, every sovereign nation suddenly realizes the urgent need to modernize, stockpile, and upgrade their defense infrastructure.
And who is the world's premier undisputed supplier of advanced military hardware, aerospace technology, and defense systems? The United States.
Exactly. So as global instability rises, international demand for U.S. defense technology skyrockets. And those massive sovereign defense contracts are almost exclusively priced, negotiated, and settled in U.S. dollars.
So we could be witnessing the transition from the petrodollar to what you might call the weapon dollar.
Precisely. If this geopolitical shock creates an unprecedented multi-decade demand cycle for U.S. defense systems, it will force foreign nations to acquire and hold massive reserves of U.S. dollars simply to facilitate those transactions.
This scenario could radically reinforce and cement the structural dominance of the U.S. dollar in international finance for the next generation, completely obliterating the consensus predictions of its demise.
It is a stark reminder that in complex, highly dynamic systems, the secondary effects often produce the exact opposite outcome of what the initial panic suggests.
That is an incredible reframing of the macroeconomic picture and exactly why we have to constantly look past the surface level fear to find the deeper structural shifts. Thank you for joining us for this deep dive. As you navigate the volatility and the headlines hitting your screens this week, remember to critically audit your assumptions, ruthlessly verify your liquidity, and most importantly, stay relentlessly curious about the data beneath the noise. We will be right here, continuing to decode the complexity with you next time.